Or can we start because we have one more slides to go in the last page of this. We sold the slides. Okay, start the other session also. For those who are online, can you hear me? Can you hear me? Anyone in those online? One more, right? Okay, now after we talk about the long run production functions, we may remember that. We talk about the ISO content, ISO of curves, right? And the about the producer's equilibrium is theta, right? We identify the conditions, right? With respect to the equilibrium, right? Producer's equilibrium, right? So which explain the long run situation, right? Now here one more things, the concept we can talk about, right? So now we know that in the long run, we know that all the variables we can change, no, right? All the inputs, no, right? In order to determine the appropriate output level, right? So with respect to changing these variable inputs and how it responds to change the output, right? So we can measure. That is something elasticity, no? So you may familiar with the elasticity, no, right? So how the output is changed with respect to change in the inputs, no, right? So the relationship between the input and the output. So we can use a concept there, the output elasticity, right? So that measures the speed of change in the output due to change in the inputs, variable inputs. So because now we know that in the long run we can take both the labor and the capital variable, no, right? With respect to change in those variables, we take it as X variables, no? Maybe either labor or the capital, no, right? So output is going to be changed, no, right? So normally you know that how we measure the elasticity, no, right? So short form, how you measure the elasticity? Take the demand price elasticity, how we measure? Percentage change in output divided by the percentage change in inputs, no, right? Same way, right? So we take the percentage change in output because production, no, right? With respect to percentage change in inputs, no, right? So that means now how we take the percentage change in output? That is delta Q over Q, no, right? So the percentage delta Q divided by Q, no, right? And the percentage change in inputs means if we take the inputs, both labor and the capital as X, no, right? Delta X divided by X. So rearranging that the equations, you can express it as delta Q over delta X over into X over Q. Likewise, you know that delta P over delta Q, P divided by Q, no, in the price elasticity, no, right? So now in other words, we can say dQ over dx if we take the differentiating forms, no, right? So that is the slope, no, right? So delta Q over delta X means the slope of the curve. So with respect to change in the variable inputs. So we can express it that dq over double Q over double X into X over Q, no? Because we assume both variables are changing, no, right? So therefore we can say double Q over double X divided by Q, no, right? So now once you calculate the output elasticity, right? So the coefficient, so based on the coefficient, so we can identify the returns to scale principle because we are in the long run, no, right? We know that we are going to change both labor and the capital, right? Both variables changing. So with respect to changing those variables, we know that output change, no, sometimes maybe at a faster rate, sometimes at a lower rate, no, right? Sometimes in a equal proportionate, no, right? So those are the three instances, no, right? So based on that, we can identify the returns to scale, no, right? So if with respect to change in the inputs, right? If the output is changed more powerfully, significantly, no, right? if the output change is higher than the input change, no, right? So that we know that there is a increasing returns to scale. So that means the EQ, if it is greater than 1, no, right? So that explains the increasing returns to scale. So by looking at this coefficient, no, right, we can check whether it's greater than 1 or less than 1, right? Because we have the ratio, no, right? Percentage changing output divided by the percentage changing input, no, right? So with that, that maybe the output elasticity may vary from 0 to 1, no, right? Right. So if it is less than 1, there will be a decreasing returns to scale. So that means output change is less powerful than the input change. No? For an example, output change is 10% with respect to the input change of 5%. No? Right? Sorry, 20% maybe. No? Right? So, right. So that means there will be a decreasing returns to scale. If it is equals to 1, so that means proportionately both input and output change. No? Right? So therefore, we can say it's constant returns to scale. So likewise, now by looking at this elasticity coefficient, right? So what you derive after calculating this output elasticity, so we can identify the relevant returns to scale, the nature of the returns to scale you can explain, right? So that is the now we can say the output elasticity delta Q over delta X into X over Q, no, right? Now here delta, the X means the variable that we incorporate, no, right? It may be labor over the capital. So we can measure output elasticity with respect to the change in labor, no, right? Separately we can measure, no, right? Or output elasticity with respect to change in the capital, no, right? So we can measure separately, no, right? So that means if you take the output elasticity of labor, so we can take the percentage change in output divided by the percentage change in labor, no, right? So that means delta Q over delta L into L over Q, no, right? So if we take the same way with respect to change in the capital inputs, no, right? So that means percentage change in output divided by the percentage change in capital, right? So that means we can express that one output elasticity of capital, no, right? So that means delta Q over delta K into K over Q, no, right? So that way we can identify the output elasticities with respect to change in both the labor and the capital, right? We can express it in terms of labor over the capital, right? So separately as well, right? Okay, right. Now if we go with that, right? Now we can identify the important. Now this is the Cobb Douglas production function, right? So here we take the output is the Q, right? So L alpha, L means the labor and the K is the capital stock. So alpha and the beta, so those are the coefficients, right? So with respect to the labor and the capital, right? So that expresses the changing output due to change in the labor alpha expressed, right? How much is output is going to be changed with respect to change in the labor, no, right? So alpha beta expressed with respect to change in the capital, how much the output is going to be changed. That measures the coefficient, no? In the equation, you know the coefficient, no, right? So that explains the relationship between the variable and the other variable, no, right? Dependent, independent variable, no, right? So we can identify, right? So here actually we know that both actually labor and the capital change. Now this is the long run situation, no, right? Now you now we can identify, right? This is the equation, right? So alpha and the beta, right? Right. Now, if we take this, if we measure the changing output due to change in the labor, and we can measure the changing output due to change in the capital, no? Right? Right. So that means if you take the first one, right? Now we know that output elasticity, we identified the delta Q, so W Q over W in terms of labor, W into labor divided by output, no? Right? So W Q over W mean what does it mean there? So delta Q over delta L, what is it? Previous slope, what is it? Or delta Q over delta K. What is it? So that is changing delta means changing output, delta L means changing labor. The ratio, what does it explain? Delta Q over W Q over W L or delta Q over delta L. So that is yeah. What does it mean? What is the concept? That is called marginal productivity of labor, right? Right. So that is the marginal productivity of labor, right? Now here we are now even in the production function, right? So that is the slope, no, right? Slope of the curve, no, right? We take the production function, no, right? So that is the slope of the production function in terms of we explain in terms of labor, no, right? So because both variables are going to change, no, right? So we can measure the changes, no, right? With respect to change in the labor and the capital. So that explains the marginal productivities of respective fractions, no, right? So delta W over W means marginal productivity of labor. W over W K means marginal productivity of capital, no, right? Because both labor and the capital change, no, right? In the short run, we measure only one variable, no? Because labor is going to be changed, no, right? In the short run production function, right? We measure the slope means the marginal productivity of labor, no, they are explained. Because capital is constant, no, right? That's not change, no, right? Now, how we measure now this is the output elasticity, delta Q over delta X into X over Q, no, right? So that means Q over W X divided by Q, no, right? Now, if we take the output elasticity of labor, so we can take, as I mentioned, no, delta Q over delta L over Q, right? Now, that is the delta Q over delta L means that is the W Q over W L, no, right? How much is output change, right? With respect to change in the labor, no? That explains the marginal productivity of labor, no? Right? MPL, no? Right? Now, if we take this one, L over Q mean what does it mean? Now, you know the average productivity, no? Right? How we measure the average productivity? So that is the output divided by labor, no? Right? Ratio between the output and the labor, no? Right? So that is the average productivity. Now here it says L over Q, reciprocal of that, no, right? Here is other way around, no, right? So that means 1 over average productivity of labor, no, right? Because here it's L over Q, not the Q over L, no, right? It's L over Q, right? So that is the reciprocal of the average productivity of labor, no, right? So that means 1 over average productivity of labor, right? So now that is one thing, right? So in the output elasticity, you can identify all these things, no, right? So if we take the slope of this production function, right? So one is the delta Q over delta L mean marginal productivity of labor. So in our production function, Cobb-Douglas production function, right? If you calculate the marginal productivity of labor, right? So we know that our production function is AL alpha, power alpha, K beta, right? So in that production function, if we calculate the marginal productivity, So that means daba Q over daba L, no, right? Okay. So we can differentiate the Cobb-Douglas production function, no, in terms of labor, no, right? Because changing factor is labor we take here, no, right? So that means if we write it in differentiating form, AL, so because power L means we multiply by the here, no, right? With this factor, right? So that means A alpha L, alpha minus 1, K beta, no, right? So that is the slope of the Cobb-Douglas production function, no, right? For the first order differentiation, no, right? A alpha L, alpha minus 1, K beta, no, right? We can write it this equation, this form, no, right? So because now here the the L to power alpha, L to power minus 1, no, right? So L to power minus 1, we can take it down, no, right? To make it positive, no, right? If the that index, no, right? Index numbers, right? So we can write it this equation A alpha L to power alpha K beta divided by L, no? Same thing, right? Right. So now if we substitute that one, right, this equation to the output elasticity function, right? Because our output elasticity function is delta Q over delta L or daba Q over daba L into L over Q, right? So daba Q over daba L means A alpha L to power alpha K beta divided by L, right? Into L over Q, right? So we express, so substituting that one, right? This function, right? Output elasticity. So you can simplify it, right? Finally, what you gain, right? So you can cancel out the similar things, no, right? So finally, output elasticity equals to what? There. Finally, it remains alpha, no, right? Alpha remains, no, right? You say all the things cancel out, right? So finally, output elasticity of labor means the alpha, right? So that is the coefficient of the labor, no, right? Right. That is the coefficient of the labor, right? Right. So now the output elasticity means the so that alpha indicates the output elasticity of labor, no, right? Right. The coefficient, no, right? In the Cobb-Douglas production function, right? The coefficient which denotes the labor, no, right? Equal to the output elasticity of labor, right? So that means with respect to change in the labor, how much is output going to be changed, right? Percentage change in output due to percentage change in the labor, right? So that is the alpha, right? Same way, if we apply this to the capital, no, right? So with respect to change in the capital, so we can express the output elasticity. Yes. So delta Q over delta K into K over Q, no, right? So that is output elasticity of capital, right? So we can take the slope of the Cobb-Douglas production function, daba Q over daba K, no? If you differentiate the production function in terms of capital, right? We write it L alpha beta A to power B minus 1, no? Because we differentiate the production function in terms of capital, no, right? So beta we multiply, no, beta K, beta minus K, no? Right? We can write it this way, right? And we take it this negative, right? Make it positive, right? Taking down, right? So then we can, if you substitute that equation to the output elasticity, so we can find out output elasticity of capital that equals to beta, the coefficient of the Cobb-Douglas production function, right? Which denotes the capital, right? Right. So that means output elasticity of capital means coefficient beta in the production function explains, right? So that means the how much is output going to be changed? It will change in the capital, right? In the long term. Because we know that both labor and the capital change in the long run, right? So we can measure with respect to change in both variables, data and the capital, right? How much is the output going to be changed, no? Right? So that means if we take this alpha and the beta, what does it explain? So that explains the change in output due to change in the inputs, no? Right? Data and the capital, right? So if you take in the production function, right? If you take the AL alpha, A beta, right? Alpha and the beta, if you consider there, right? Once you measure this production function, right? The coefficient, if you can take it this alpha and the beta, right? So that explains the returns to scale, right? One is with respect to change in the labor, other one with respect to change in the capital, right? If you add alpha and the beta, no, right? And you can see whether it's equals to 1, whether it's greater than 1 or less than 1, no, right? So that indicates the returns to scale. Okay, shall I now? I will develop that is available in the link side. Let me now production function, right? You know that Q equals alpha K beta. So if you take these alpha and the beta, those are the coefficients, right? So that explains the output elasticity of labor, right? And the output elasticity of capital, right? So that means if we take the alpha and the beta together, right? If it is greater than 1, that explains the increase in returns to scale, right? Because with respect to changes and the labor output change is more powerful, right? So alpha and the beta, if it is less than 1, that explains the decreasing returns to scale. Alpha and the beta, if it is equals to 1, that explains constant returns to scale, right? So for an example, our production function, if we take this way, now 70, right? To power 0.7, k to power 0.2, right? Right. Once you measure this production function, right? So alpha and the beta, now alpha is 0.7, beta is 0.2, right? So that is 0.9, no, right? So less than 1. So that explains the decreasing returns to scale, right? So once we evaluate this production function, once you measure the coefficient of the production function, right? You can, by looking at the alpha and the beta, right? You can identify the nature of the returns to scale, right? Okay. So now we know that production function, if you this differentiate, no, right? Production function, right? So this is actually slope, no, right? Production Pope-Douglas production function slope of the Pope-Douglas production function, right? So that explains the marginal rate of technical substitution, right? So that is the production function, no? Slope, we remember, no, right? So MRT is, no, right? Slope of the production function, right? So that in turn equals to the marginal productivities, no, right? Of the respective factors, no? You may remember at the equilibrium point in the isopont and the isoforce, no, right? So that is the MRTS, and that equals to the relative marginal productivities, no, MPL over MPK, no, right? And the price level even, no, right? Right. So that is the MRTS, the slope of this, we take this production function in terms of with respect to K over L or L over K, no, right? So that you can measure the MRTS, marginal rate of technical substitution, right? So, no, right? Okay, so, based on this, actually, I will give you one question for you, right? You need to give me the answer next tomorrow, right? Okay, right. This question, right? I will give you the later, right? Shall I now? I will, okay, I will show you, right? The question, right? So today I will upload to the next slide. That is something talk about the efficiency, right? Okay. So, we will talk about it a bit today also, right? Right. Anyway, once we continue to the other question, right? So this is the question, right? So, we need to define the economic efficiency, right? And the economic efficiency, right? Producer has to take into account both marginal productivity of factors of production and their factor prices, right? So, do you agree, right? So, you will justify your answer, right? Okay, tomorrow, right? You need to submit your answer, right? Yes, okay. So, you can take some points, right? To take into today's discussion as well, right? Once we move into the other topics and then, right? Okay. Now, the economic efficiency and how it is related with this production function and so on, right? And things like that, right? Right, so that is the question, okay? Deadline tomorrow, right? To submit before, well, no, well, midnight, no, right? Okay, you have time, right? Now, we will move to the next topic, right? Now, do you have any questions to ask from the previous discussion? So, once we review the things, right? Maybe the textbooks, maybe the lecture materials, that's. If you have any question, you can ask questions, any problem areas, clarification if you need, or any areas, it's explaining certain concepts and so on. Do you have any questions?
We have questions to them. Questions to them. This calculation.
Research. Now,
So we will upload electricity questions for the past paper.
past papers now, yes, I will take it. So, right? Okay, I will give you some questions. You do test like this. So once you finish this most standard production, right? So I will give, right? Some certain areas also there, like we need to look at, right? So before we come to the markets, right? So I will give you a tutorial and the review questions there, those are the descriptive ones, right? So those some of the decision making calculation parts I will give you separate, right? So right now that is the one aspect now the cost, no? So output, right? No, right? So we need to combine both the output and the cost, right? Because when the producer take decisions, he has to consider, right? Not only the output, cost also, no, right? So right. Later on, we can give combining some questions over these areas. Okay.
So will you consider this a quiz or make it as you
Now the first one is given, this is the second one, right? So and now I will give you only two, right? So right, so, and there will be the group, today I will give you the group assignment also, right? Right, to you, right, and we have the sufficient time, right? And also we are having, after finishing the next topic, right? So we will have the MCQ test, right? Okay. Means, now that will be online, okay, MCQ online, right? You can use the text material or right, but it will give you an text with limited time, right? You need to answer the question, right, in that slide, right? Therefore, we have no time to require the material and answer the question, right? If you do that way, you will end up with few questions, right? During the time frame, no? Right? So therefore, you need to ready for that, right? Based on the topic that we covered, right? So this one and the next one, right? For the markets, right? We will give you another MCQ, right? Okay. So and I want to know now the group assignment today I will give you, right? Tomorrow I will. From tomorrow it will be effective, right? So how do you have any groups? In the previous courses, groups are there. I will get it from the right. So in I will. So you have the how you make the groups? It's your own way or consider will by the groups. You decide your group or what is the method you apply? From the list, first five or first right that way we make the group, right? Okay. Once we get the group, right? Once we get the list, okay. So how is the group work? Is it nice or enjoyable? When you are doing the group work within your group, all group members are actively participating. How is your experience? Group members are, you know, right? Normal behavior, right? Even in the organizations, no? We take the groups, right? Some members active, some members non-active, you know, right? So you also feel same experience. Huh? Oh, how it is your group? Huh? Funny. Enjoyable in your group. Right? Okay. So anyway, so now I will take that. So if I don't know whether I have time to take the presentation, right? So if I take extra time for the presentation, right, I will make it, right? Because otherwise the no time to have the presentation in the lecture time, right? Because we have to cover the contents, right? So I will ask separate time for the presentation, right? So if there's a presentation, right? So I can check whether how your participation in the group work and so on, right? So the members, the group need to be present, right? At least in mind apart, no, right? Okay. So that is the group work, right? So I will give you the question, right? So that is simple question, right? I will give you based on the discussion so far, right? Okay. You can do it, right? Right, now we are coming to the cost and the revenue, right? Because we are going to talk about this profit maximization, right? So we need to identify this cost and the revenues, right? Now, so far we talk about the what we talk about the output determination, no, right? So how the producer decide the maximum output level, no, right? Based on the production function, no, right? So as you know that producer, right? So now taking when you consider the production function, no, it explains the maximum production capacities, no, maximum output that the producer can produce, no, by combining these inputs, no, right? So that is the production function, right? So, but when the producer maximizes the output level, no, he has to consider this cost also, right? So output actually now he has to incur cost, no, right? When the producer acquiring this labor and the capital or the other factors of production, no, right? So therefore, even though we talk about the cost, output maximization, no, so that depends on the cost, no, right? Right, cost factors affected, right? So therefore, we need to look at the cost, right? So now in the previous discussion, we talk about how the output is changed, right? Depending on the time period, no, right? Short run and the long run, no, right? And we experience some laws applicable, no, right? No, in the short run and the long run, let the producer maximize output by changing the inputs, no, right? So in the short run, decreasing returns to scale, no, right? Diminishing marginal returns to the variable factor proportion, no, right? And the long run, we identify the return to scale, right? Because in the long run, all the factors going to be changed, no, right? In the production decisions, no, right? So producer can change both labor and the capital, no? So there is no matter of variability, no, right? In the long run, right? So there is no problem. No need to think about the fixed factors, variable factor, because all the factors going to be changed in the long run, no, right? So that's where we talk about these laws also, right? So in the short run and the long run situations, no, right? When the production are taking place, no, right? So now at the end of this discussion, basically, right, we look at the we identified the cost factor, right? So the nature of cost, right? So different cost forms, right? In the short run and the long run, right? And we identify the marginal approach also, right? Marginal cost, right? And the profit maximization, we need to look at the other aspect, revenue also, right? Marginal cost and the marginal revenue, right? And we finally we talk about we are going to talk, right, how the producer maximize profit, no, right? So that means the relevant output level and the price level, no, right? So profit maximizing output level and the price, no, right? So we need to determine, no, right? And the maximum profit, no, right? So what are the different approaches that we can use to measure the profitability of the business, no, right? So those things we are going to talk about, right? So now we know that this cost, right? So as we mentioned, before moving to this, right? So in this discussion, we talk about the production function, right? So that explains the, as we mentioned, now we know that the production function producer change the labor and the capital, no, right? In appropriate way, no, right? Based on the technology, no, available and reach to the maximum output level, no, right? So there, right? So that talk about, as you mentioned, the technical efficiency, no, right? Yes. Something technology, no, right? Because the factor combinations is associated with the technology, no, right? So how did the producer maximize output level, no, right? So that explains the technical efficiency, no, production function. Explain the technical relationship between the input and the output, no, right? So that talk about the technical efficiency, no, right? So that means now the producer maximize the output level, no, right? How the producer reach to the optimum output level, no, right? By combining the labor and the capital at a given technology, no, right? So it explains the technical efficiency, no, but economics we, as now in the previous discussions also we highlight, right? So something, I mean, the cost isocon, right? We highlighted the cost minimizing output level, no, right? So that means we need to think economics. Basically, we talk more concern given to the production function with the technical efficiency, right? But we need to think about the cost minimizing output level, no, right? So that is the economic efficiency, no, right? Economic efficiency means we need to produce output at a minimum cost, no, right? Because in the economics, we are going to achieve the economic efficiency and there is a welfare motive also, no, right? Because we need to satisfy the people, no, right? Fine. Right? Produce both goods and service to satisfy the people, no, right? If we can satisfy a number of people, no, right? By producing at a minimum cost, no, right? So that is the main objective, no, right? Therefore, we talk about the economic efficiency, right? Not only the maximizing output, we need to, condition is we need to produce output at the minimum cost, right? So that explains the economic efficiency, right? So in the previous discussion, we talked about this, right? So based on the isopont and the isocost, right? At the equilibrium point, right? We know that the slope of these two curves is equal, right? So at that point, it produces the economic efficiency, economically efficient output level, right? So the one which produce the maximize output, minimizing the cost, because we take into account production function and the cost function both, right? Yeah, right. So that explains the cost minimizing output level, optimum output level. So that's a tangent point, equilibrium point, right? In the production function and the isocost curve, right? So that explains the economic efficiency, optimal output level. So you know what are the conditions, all these things, right? At that point, right? So you can take the analyze all these things, right? The conditions applicable to achieving the economic efficiency. So in other words, it was expansion part, right? In the long run, right? So when the producer increase the cost, right? There is a possibility to incorporate more labor and the capital, right? And reach to higher production level, right? So equilibrium points, when the isopont maps, right? So explain the expansion part, right? So those equilibrium point, right? So along the expansion path, even, it explains economic efficiency, all the point in these equilibrium points. Right? So that is the economic efficiency, right? Now, but when we are achieving that economic efficiency, all these things we highlighted, right? Cost is very important, right? Cost, right? We have to think about the cost, right? Because now is the output and constraint is the cost, right? Right, that depends on the availability of the funds, the expenditure, or the factors of production, right? So therefore, we need to think about the cost, right? Now, we are trying to maximize the profit, right? And we means for firms, right? You have to think about as a firm, right? As a producer, right? Producer means production unit, right? We always consider, right? For the single producer, right? Generally, we talk about, right? Now, the firms always try to maximize profit, right? But we talk about, apart from that, right? By considering this ownership and management, right? It may deviate to other objectives, we talk about that. There are other set of objectives, right? Management try to achieve. But the main point is there should be profits, right? As a business firm, right? Firms needs to earn profit, right? So the profit is there, as a main objective, right? Now, how we reach to the profit, right? So that need to be find out, right? So the price and the mainly now when you talk about the profit, that mainly depends on the revenue and the cost, right? Revenue depends on the price and the quantity, right? And the cost depends on the mainly the factor, in prices and how much we use, right? Quantity, right? So all these things depends on the market conditions as well, right? Like different markets, right? So we will talk about later all these things later, right? So all these factors, right? You can identify that. So later we will talk about different market structure and so, right? So that is the difference between the revenue and the cost, right? Okay. On revenue and the cost, right? Now, when you talk about this cost, right? So we need to differentiate the accounting cost and the economic cost. So how we ascertain the cost, right? In terms of accountant's point of view, right? So you are doing the accounting, right? Financial accounting, right? That point of view, and also economic point of view, right? So the cost is different, no? What is the difference? Now in accounting, you measure the cost, no, right? So according to the accrual basis, no, right? Right. To take into account all the costs incurred, no, during that particular time, no, okay, during the financial year, no, right? Paid or not paid, no, right? According to the accrual basis, no, right? So that is, we take basically accounting cost means we take actual cost, no, right? But when it comes to the economic cost, so there is more meaning, no, right? Because in economic cost ascertained, right? The economics normally consider not only the actual cost and also the opportunity cost involved in such decisions or the projects, no, right? So that's why we say economic cost is the real cost, right? It's the real cost, not the actual cost, include opportunity cost also. That means the explicit cost, which is actual, no, right? And the implicit cost also include there, no, right? So that is the opportunity cost. Implicit cost mean opportunity cost, right? So in the total cost mean the explicit plus implicit, no, right? So we take into account, right? So that's why we say economic cost is real. So that's now when we talk about this project, no, right? You know that when we are going to implement the project, you have to look at this, to consider all the cost streams, revenue streams, no, right? So that's why you have to do the feasibility study, no, right? Right? Large project, we know that so many aspects look at, no, right? When we accept the project, no, right? Before the project, no, acceptance, we have to do the feasibility study, no, right? So we look at different aspects, no, right? Market feasibility, no, environmental, no, financial, no, right? Likewise, no, right? So many in a big projects, we look at all these things, no, right? Finally, we decide whether the project is accepted or not, no, right? If it is the feasibility study become positive, no, right? Right. Sometimes even though it's positive, it make it positive, you know, in the government projects, right? So that is something else, no, right? Anyway, right? Even though the environment is not feasible, right? So they will write it as feasible, no, right? So that is something else, right? But now here, when you talk about this project evaluation, no, right? You are doing the project evaluation, no? Project management, right? So now we have to consider the cost, no, right? Relevant cost, no? So that's otherwise, if we make it our decision, no, right? We take the wrong decision, no, regarding our project, no, right? Without considering the relevant factors, relevant cost, no, right? So we will come up with wrong decision, no, right? So therefore, we need to evaluate the cost, no, correct, no, right? Factors, no, right? So that's why economic cost is more important because it's considered for cost associated with the decision. So in the project, no, right? So it's easy to take into account both actual and the opportunity cost, no, right? So that is the difference between the accounting cost and the economic cost, no, right? Economic cost is more important, right? In the project evaluation, since it considers all the relevant costs, no, right? Which includes actual cost plus opportunity cost, no, right? Implicit cost, right? Right. So now the profit maximization, right? Now we talk about later the profit maximization, no, right? So simply if we take the revenue, total revenue and the total cost is the profit, no, right? So where the profit is maximized in that sense, right? So the gap between the revenue and the cost, no, right? The point where the gap is wide, no, right? At that point, profit is maximized, no, right? No, right? Since we take the total revenue and the total cost, no, right? So that means the variation of the cost and the revenue mainly goes to the profits, no, right? So when you talk about, there can be variations, no, in the cost. Sometimes cost increase, sometimes cost decrease, no, right? Because we know that we are talking about the sometimes maybe the short run, no, maybe the long run, right? So in the short run, we increase the cost, no, right? fixed factors, variable factors, both are there, no, right? But instantly there can be rise in the cost, right? So there some changes may occur, no, right? And even in the long run, no, right? There may be fluctuations of the cost, right? So that will explain the profit, no, right? So this variation of the cost and the revenue vary, right? In the short run, regardless of the time period, no, right? Explain the profit, right? Now, even though we talk about this profit maximization, is the now we know that we maximize the profit, we know to maximize the revenue, no, right? And minimize the cost, no, right? Because the point where the gap point is identified as the maximum profit, no, right? But in some cases, what happened? Even though the revenue was maximized, and sometimes cost also increase, not minimize, no, right? Even at profit can be earned, no, right? Even at higher cost, no, right? And that depends on the market situations, no, right? Market conditions, they take some imperfect markets, no, right? Monopoly markets, those firms, big firms, no, right? So they can control the market, no, right? Small firms, no, right? There are big firms, so those are the monopoly firms, no, right? Big firms means monopoly, no, right? So they can control the market, no, right? So that means even at higher cost, no, right? Those firms can maintain the profits, no, right? Even though we talk about this, the difference between the revenue and the cost, no, right? In order to earn more profits, revenue should be maximized, cost should be minimized, but even some certain circumstances, no, right? Even at higher cost, even profit can be earned, no, right? So therefore, profit maximization and the cost minimization is two different things, no, right? Different, no, right? Profit maximization and the cost minimization, right? Okay. So now let's go to the cost, no, right? Now, basically, the theory of cost deal with the classification of cost and the variation of the cost with the output, right? Now, we know that output, when we reach to the output level, right? When we make the production, no, we need to incur cost, no, right? But cost depends on the output, no, right? Because cost function explain the relationship between the cost and the output, no, right? Because cost depends on output, no, right? All the cost functions, no, right? Not only the cost, revenue, profit, all the things depends on the output, right? So that is that's why we need to remember, right? So all these cost, revenue, right? So it depends on the output, right? So now since the cost relate that explain the cost relationship between the cost and the output, no, right? Cost depends on the output, right? So that means cost depends on the production function, no, right? So therefore, we need to think about, right? When we analyze the cost, production function also, no, right? So then total output, right? Cost depends on the output, right? Cost function explain the relationship between the output and the cost, no, right? Now, since it relate with the production function, no, right? Depending on the variability of the factors of production, no, right? Cost may vary, no, right? In the short run, we know that we identify variable factors and the fixed factors both, no, right? In the short run, production is subjective to change in the variable factors, keeping the fixed factors constant, no, right? Right? So therefore, in short run cost, the cost may be short run or the long run, no, right? So short run cost associated with the short run production function, no, right? Long run cost associated with the long run production function, no, right? Cost is depends on the output, cost is depend on the production function, no? Production function we explain short run, long run, right? Depending on the factor variability, no, right? Right? So therefore, we can identify, we can classify the short run production, short run cost, long run cost, no, right? So you can identify short run cost curves, long run cost curves accordingly, no, right? Right? So that is very important, right? So identify these different forms of cost function in the short run and the long run, right? But all these cost function depends on the output, you know, depends on the production, right? Is it clear? Okay. Now we talk about this, right? So there will be a question, that's why I include there, right? Today, questions I gave it to you, those who participate late, right? So that will be available tomorrow, right? There will be a question given to you, right? You need to submit. Sorry, today itself is available in the LM, right? And you need to submit the answer tomorrow, right? So based on something related with this economic efficiency, we gave you the question, right? So we talk about the technical efficiency, right? So that explains the production function, no, right? Since the producer try to maximize the output by changing the labor and the capital, no, right? The producer always try to maximize the output, no, right? By combining appropriate combination of the labor and the capital, no, right? So that explains the technical efficiency. In other words, production function explains the technical efficiency, right? If I repeat it, right? So, but there also we know that cost is important, right? Economics mainly concern the cost also because we need to produce cost minimizing output level, no, right? So that's why we are more worried about economic efficiency, no, right? Right. So in economics, we talk about the cost minimizing output level, no, right? So in other words, at the tangent point of the isocost and the isocont, use the cost minimizing output level. So that is the optimal output level, no? We call it as optimal output level, right? So in that, actually, we know that. So at the equilibrium, at the optimal output level, right? But producer growth, producer has to take into account this marginal productivities and the prices, no, right? Right. So you can recall previous discussion, right? The conditions apply the production when the producer maximize output level, no, right? Or when the producer optimize output level, no. At that point, that is the equilibrium point, no, right? At that point, the marginal productivities of the respective factors equals to the ratio, right? So we discussed, right? Okay, right? So we need to justify that one, right? Economic efficiency and the these productivities and so on, right? So that is the question. Okay, right now, since we identified this cost, right? It vary with the output, right? Depending on the factor variability, no? Cost also vary, no, right? So that's why we consider the short run cost and the long run cost, right? So the short run production function, we know that, right? So in the short run, right, we identified labor and the capital, no, right? So their capital is constant, right? In the short run, production function explain how the producer maximize output by changing the variable inputs, no, subjective to the given fixed factors, no, right? Right? Right. So now is the short run production function, right? There are fixed factors and the variable factors, no, right? So we identified the cost also, right? Based on that, no, right? Short run cost and the so fixed cost and the variable cost, right? Right? Since there are fixed and the variable factors, no, right? Because fixed factors, we know that, no, right? And the variable factors, right? In the production process, basically, there we identified capital is the fixed, no, right? Commodity type, capital term, right? And the labor is the variable factor, no, right? That function, right? So in the short run, we can identify fixed cost and the variable cost, no, right? Is the there we identified is both fixed factors and the variable factors in the production process, right? So, but when it comes to the long run, right? The long run production function, no, right? So we know that there are all the factors variable, no, right? It explains the scale of the business, no, right? The long run, we are going to expand the scale of the business, no, and reach to the maximum output level, no, right? So with respect to the long run cost, right? That explains the scale of the business, no, right? In the long run, right? So we take the long run total cost. Basically, we take the most important thing is long run average cost, no, right? Average cost, right? So that also explains the cost variation with respect to change in the scale of the business, no, right? Because we expand the business, no, right? To go for a higher output level, no, right? We had more capital, more labor, no, right? So all these factors are variable, right? So that explains the cost variation with the variation of the scale of the business, no? So that's why it generates economies of scales, no, right? In the long run production function. So am I going fast? No, no. Right, just now we identified the short run cost and the long run cost, no, right? So short run cost, when we explain, we can identify by looking at the variability of the factors, no, right? If there are fixed factors and the variable factors, fixed cost and the variable cost, no, right? And also we can identify other based on the marginal cost, no, right? Marginal cost and the average cost also, right? In the long run also, right? So we can identify this on the variability of factors of production, explain the scale of the business, no, right? So accordingly, how the cost vary, no, right? So especially the average cost, right? Right. So what is the now that we talk about the short run cost, no, right? So now we know that short run, we identify the fixed cost and the variable. So what are the fixed costs in the short run? I mean, in the capital, oh, that's building, expenditure on buildings, machinery, no, right? Not only that, no, right? Some overhead cost also there, no, right? That not depend on the output, no, right? Now the fixed cost means it's fixed, no, right? It does not depend on the, or it does not vary with the output level, no, right? Right? So even though the output increase, even though the output decrease, no, even though at a short period of time, if you discontinue the business, no, right? Sometimes, no, right? Or temporarily, you shut down the business, no, right? Temporarily, no? There will be fixed cost, no, right? We have to incur the fixed cost, no, right? It is fixed, no, right? Right? It does not vary with the output level, no, right? Now, normally, we know that this expenditure on buildings, materials, sorry, machineries, no, right? And some other overhead cost also there, no? We can take as fixed cost, no, right? Now, for an example, rent, no, right? It does not depend on the output, no? It depends on the square feet, no, right? Insurance, no, right? Some administrative overhead, administrative expenses, no, right? Salaries for the this sales manager or something, no, right? Administrative expenses, interest payments on capital, no, right? So those are fixed, no, right? Does not vary with the output level, no, right? So that is the fixed cost, no, right? So since it's does not depends on the output, even though there is no production, no, right? Even though we shut down the production, there will be a cost, no, right? Because that cost is already incurred, no, right? Right. So that's why normally when we draw the fixed cost curve, no, right? We draw the vertical curve, no, right? Right. Sorry, horizontal curve, no, right? With respect to the output aspect, no, right? It can be given cost, right? So that does not vary with the output level, right? So the fixed cost, right? So that is the fixed cost, right? So the variable cost, what is variable cost? Variable cost means it vary with the output level, no, right? So those costs we call it as prime cost, no, basic, direct cost, no, right? Direct cost, no, right? When you increase the output level, variable cost also increase, no? You decrease the output level, variable cost is decreased, no? If you shut down the production for a shorter period of time, no need to incur variable cost, no? Unlike the fixed cost, right? Vary with the output level, no, right? So that is the variable cost, right? So now how we form the total cost in the short run means since we have fixed both variable, no, right? So total fixed cost plus total variable cost, no, right? So the TC is the total cost, no, right? So it's TFC plus TVC, right? Okay. Now if you draw the variable curve, right? So this is the fixed cost, right? So this is the output level x-axis. We put the y-axis cost, no, right? So the fixed cost is fixed, no, regardless of the output, no, right? It is independent from the output, no, right? It's given, no, right? Already in there, right? Horizontal curve, right? But in the variable cost, if you take, right, start from the origin, no, right? Right? Because if there is no production, no variable cost, no, right? When the output increase, variable cost also increase, no, right? So the nature is at the initial level of output, right? Variable cost increase at a faster rate, no, right? Right? Then somewhat constant. Again, at higher output level, it increase at a faster rate. So that means normally if you see this nature, right, of this variable cost, it's inverse S shape, no, right? Inverse S shape, no, right? And the total cost, red line denotes the total cost, no, right? How you take the total cost? FC plus VC, no, right? So the FC plus VC means the total cost. So it start from at the point where the fixed cost start, no, right? No, right? Because at the zero level of output, there's a certain level of fixed cost, no, right? So the total cost means that TFC plus TVC. So that means start from the point at the initial point of the fixed cost, no, right? It's also inverse S shape, no? So behavior of the total cost also similar to the behavior of the variable cost because total cost, no, mainly the variation of the total cost explained by the variation of the variable cost, no, right? Because fixed cost is fixed, no, right? It is constant, no, right? It does not vary with the output, no, right? So therefore, the total cost, the variation of the total cost may be explained by the variation of the variable cost. No? That's why parallel, no, right? If you see the variable cost and the total cost, it's move parallelly, no, right? So the difference between the variable cost and the TC is what is it? So that is this difference is fixed cost, no, right? Difference is fixed. Since fixed cost is fixed, this difference always fixed, no, right? When you draw the curve, right? Similar gap you need to draw it, no, right? So this difference explains the fixed cost, right? So this is inverse S shape, no? Both the variable cost and the fixed cost, right? Okay. So that is the fixed cost, right? So then we talk about the average cost also, no, right? The average cost is per unit cost, no, right? Cost per unit, so we calculate, no, right? So for our decision making, no, right? Not only the total cost, average cost, no, right? In economics, we also talk about the average cost, no, right? That is the per unit cost, no, right? So the ratio between if we take the average cost mean total cost and the output, no, right? So since the total cost is explained by the THC plus TVC, average cost means average fixed cost plus average variable cost, no, right? So how we take the average total cost? So that is the TC divided by Q. So TC means FC plus VC, no, right? So then average cost means average fixed cost plus average variable cost, no, right? So that means TFC divided by Q, TVC divided by Q, no, right? So unit cost. So that is the average cost, right? So ATC means average total cost equals average fixed cost plus average variable cost, right? So that is the average cost, right? Now we know that fixed cost is fixed, no, right? Total fixed cost is fixed, no? We divided by the output. When you increase the output level, no? When you increase the output level, what happens? AFC always decrease, no, right? Because fixed cost is fixed. When you increase the output level, average fixed cost continuously decrease, no, right? When you increase the output level, right? But the variable cost increasing, no, right? First increase at a faster rate, then somewhat constant, then it increase at a very faster rate, no, right? So since continuously increase, no, right? So the variable cost also vary according to average cost, right? So that means initially when you take at a higher output level, right? Because output increase at a faster rate, no, right? So that means average cost increase, no, right? So then somewhat total cost, total variable cost somewhat stable. So at that level, when you increase the output, that means even though that average variable cost is somewhat constant, right? Then after that, average variable cost also increase, right? So we see, right, based on the total variable cost, right? We can explain average variable cost also, right? Variation. So ATC average total cost that equals to average fixed cost plus average variable cost, right? Then marginal cost. No? So that is also important, no? Right? We know that in business economy, we consider the marginal approach, no? Right? We take the slope of the curves, no? Right? In order to make decisions, no? Right? Marginal cost, marginal revenue, no? Marginal profit, like that, you know, right? So the marginal analysis is very important analytical tool that we used in business economy, no? Right? Marginal analysis, right? So the marginal cost. Therefore, the marginal cost also very important cost, right? So when you make decisions, right? In economics, right? So that is the addition to the total cost, no, right? With the change in the inputs by 1 unit, no, right? Output by 1 unit, no, right? So when you increase the output by 1 unit, no, right? How much is the total cost variation, no, right? So the marginal cost explains the variation of cost, no, right? Total cost due to 1 more unit of change in output, no, right? So that means delta TC divided by delta Q, no, right? So in other words, that gives us the slope of the total cost curve, no, right? Slope of the total cost curve. So that is the marginal cost, no, right? So in other words, if you differentiate the total cost function, no, right? No? In terms of what? In terms of what? We differentiate. In terms of labor, in terms of capital, or in terms of output. Output, right? Because cost depends on the output, right? The marginal cost also depends on output, right? We differentiate the total cost function in terms of output, no, right? Delta TC over delta Q, no, right? So we take the D TC over DQ, no, right? So that is the marginal cost, no, right? Now, actually, now in the marginal cost, so that is the slope of the total cost function, right? You know, we know that short run cost is inverse S shape, no? Short run total cost, no, right? Inverse S shape, right? If you take the slope of that curve, right, that explains the marginal cost. First increase, the slope also But at the increasing part, we see if you measure the slope, right, what happened? It's continuously decreased, right? Somewhat stable and then slope increase, right? So that means it's also U-shape. All the marginal average cost becomes U-shape, no, right? U-shape curves, right? That explain the short run cost variation, right? With respect to change in the output, no, right? So we know that it explains the diminishing marginal productivity of variable factor proportion, right? Since we are talking about the short run situation, no, right? So we try to increase output subject to the given fixed factors, no, right? Right. So that is the situation. We will talk about later the shape of these curves, right? So now we identified the total cost, no, right? And the marginal cost, no, right? And the average cost, no, the short run, right? So in the short run, total cost mean it comprises with the total fixed cost and the total variable cost, no, right? And the average fixed cost and the average variable cost, no, that form the total average cost, no, right? So the marginal cost is the slope of the total cost function, no, right? And in the short run, variation of the cost mainly explained by the variation of the average cost. Do you agree? Statement is correct or not? Sometimes I may write it in a wrong way, no, right? So we'll to the neighbor, right? They remove, right? I may write in different things, right? Okay, here or there, right? Something else will be not right? So now, do you agree with this statement? In the short run, the variation of the total cost mainly explained by the variation of the average. Sorry, it's average, no? Average cost. So the variation of the variation of average cost, is it correct? Don't take it my wording as it is, right? If you have any confusing, right, you need to raise your voice, no, right? So that is not the average variable cost. Am I right? That's good. Do you agree or not? Right. So short run total cost mainly explained by the variation of the average cost. Average cost mean average fixed cost and average variable cost. So those two are there, no, right? But it mainly vary with the average variable cost, no, right? So that means if I say the marginal cost mainly depends on the average variable cost. So the marginal cost means, now if we take the marginal cost means delta TC over delta Q no, right? We can write it, if I write it, marginal cost means delta TVC over delta Q. Do you agree or not? Delta TVC divided by delta Q, marginal cost. Do you agree? You agree or not? What is your idea? Because now we know that this total cost variation, right, in the short run, no, right? The total cost mainly varied with the variable cost, no, right? Not the fixed cost, no, right? And the marginal cost means the slope of the total cost function. So that also explains the variation of the total variable cost, no, right? Right. So the marginal cost means it explains the variation of the total variable cost due to change in the output, no? Right? Okay. So that is mainly the cost, mainly influenced by the variable cost in the short run, no, right? So the marginal cost also same, right? So that means we can write it marginal cost equals, earlier we wrote it as delta TC divided by delta Q, no, right? Delta TC means total cost divided by change output. But now we can write it delta TVC divided by delta Q, no, right? Okay. So agree or not?
Yeah.
Okay, right now, marginal cost, right? Well, delta TBC divided by delta, right? So, total cost means total fixed cost divided by plus total variable cost, right? So the marginal cost means, that means the total cost divided by total cost, right? The total cost means we can write it as change in total fixed cost. Delta Q plus change in total variable cost divided by delta Q, right? Everything looks like. Now, if we take this one, total fixed cost divided by delta Q, right? Is there a change in the fixed cost? That is zero, right? So this becomes zero. Plus change in DDD divided by delta Q. So that will equal to the marginal cost, right? Because this becomes zero, right? Right. So therefore, marginal cost means delta TBC divided by delta Q, no? Right? Okay. Right. Okay, right. So we talk about this, right? We know the shape of this total cost curves, right? So it was the shape, right? And the total cost is mainly explained by the variation of the total variable cost. Since the fixed cost is constant to the period, right? Sometimes you know that if you are doing management accounting, no, right? So those who are doing the same right? Those who are doing management accounting, right? So in management accounting, sometimes during the different activities, right? So we take it the fixed cost is fixed, no, right? Or throughout the fixed cost is fixed, right? So in a particular activity, right? So that means for activity level, right? So we assume the fixed cost is fixed, right? There can be fixed cost levels, right? According to the activity management accounting, right? Depending on the activity level of the business. But here in economics, we take it the fixed cost is given, right? It's fixed, right? So regardless of the output or dependent on the output, right? Right. Now we take the marginal cost and the average cost function, right? How we draw the marginal cost? That is the slope of the total cost curve, right? In different points, if you measure the slope of the total cost function, right? So that means at different points we need to change our foot level, right? So what is how much is the cost variation, right? If we ascertain in different points, right? You can measure the marginal cost, right? So the marginal cost curve, right? Now we know the total cost curve is inverse here, no, right? if you measure the slope of that, right? Initially, the slope is decreased, right? Then it's come to the minimum level, then after that, slope tends to increase, right? You draw the tangent line to the total cost functions, you see, and if you measure the slope of those tangent, right? Initially, the tangent lines at the inverse S-shaped curve, right? It's decrease of slopes. Then come to the minimum level, then thereafter the slopes tends to increase, right? It's inverse, sorry, U-shape, right? And the average fixed cost curve, right? Because when you increase the output level, no, right? Average fixed cost continuously decrease, right? Because the total fixed cost is constant, right? So the total fixed cost constant, right? When you increase the output level, or unit cost continuously decrease, no, right? And the average variable cost, that's also U-shaped, no, right? So that also based on the total variable cost inverse S-shape, right? If you draw the line from the origin to the average variable cost curve, right? So you can see the slope of that curve, right? For example, there was no mention, right? This is the total cost curve from height. If you at different points, right? If you draw the tangent line, right? Right. So you see the tangent line, right? Slope increase, right? Then again, slope increase, right? Then in the marginal cost curve, also U-shape, right? If you draw the marginal cost, right? Now the average cost means if you roll the lines, right, from the origin, right? What happens if you roll the line slope? It's decrease, right? Then if you roll the line at this point, no, right? Standard line in of that. After that, if you roll the lines, what happens? It's increased, no, right? Again, slope increase, no, right? So that means average cost also, right? Those the so that also U-shape, no, U-shape increase, right? If you do the average cost, no, right? Initially it decrease, right? Then come to the minimum. And then fix, no, right? The average cost, right? Average variable cost also, same way, that is the inverse S-shape, no? If you go the lines from the origin, right? Same thing you can explore, like such and also become U-shape, right? So all these short run curves, no? Average cost, average variable cost, average total cost, no, right? And the average total cost, average variable cost, no, right? All these curves are U-shaped, no, right? So that based on the total cost, no, right? This total cost, the variation is mainly explained by the diminishing marginal productivity of the variable factor. Diminishing returns, no? Diminishing returns. Diminishing returns to the variable factor proportion, no? To the variable proportion. diminishing returns to the variable factor proportion, no, right? That is the principle applied there in the short run. So in the production function, no, right? Because we increase the output at a given level of fixed cost, no, right? Keeping the fixed cost constant, we are trying to increase the output by changing the variable inputs, no, right? So therefore, production process subjective to the diminishing returns to the marginal returns to the variable factor proportion. That variable factor is the labor there. Right. So that's why all this average cost curves, no, right, become U-shaped, right? Right. Right. So we draw the average cost curves, right? The average variable cost curve, right? So then the average total cost curves above the average variable cost, no, right? But the important thing is, right? Now this is the marginal cost curve goes through the minimum point of the average variable cost and the average cost, right? So when you draw the marginal cost curve, it should go to the minimum point of the average variable cost and the minimum point of the average cost, right? So the minimum point of the average variable cost and the average total cost is two different points, two different output levels, right? So both the average variable cost and the average total cost is not minimized, same output level, right? Right. So average variable cost is minimized at the Q1 output level. Average cost is minimized at the Q2 output level, right? It's two different points, right? And the marginal cost curve goes through the minimum point of the average cost curve, right? That is the how the short run average cost and the one cost. All these things explain how the output. Yeah, changing output with the change in the variable input, right? Right now, if you now we can take this some values, right? Right. So you can observe all these behaviors, right? In this data, right? So here see the output level, right? We increase the output level 0, 1, 2, 3, 4, like that way, no, right? Now the cost, no, cost also vary with the output, no, right? So we know that initially there is a cost, no, at the 0 level, 100. So that is the fixed cost, no, right? At the 0 output level, 100 means the fixed cost, no, right? So then thereafter we know that when the output increase, total cost also increase, no, right? So normally the total cost increase at the initial levels, total cost increase at a faster rate, no, right? To take these differences fast, no, right? Then thereafter somewhat increase, stable, okay? Then thereafter increase at a faster rate, no, right? Now this is the fixed cost. It does not vary with the output, no. Initially at the 0 level 100 means fixed cost is 100, no, right? So the period, no, regardless of the output level, fixed cost is fixed, no, right? And the variable cost, how we take the variable cost? Now you know the total cost, you know the fixed cost. The difference between the total cost and the fixed cost is the variable cost. At the 0 level, there is no variable cost, no, right? Output, no, right? When the production increase, variable cost also increase. That is the difference between the total cost and the fixed cost, no, right? So here 146 minus 146, no? Likewise, variable cost also it can initially increase at a faster rate, no, right? So then somewhat stable, then thereafter at the latter part, no, at higher output level, it increase at a faster rate, no, right? So that is the difference we take here, the difference between the total cost and the fixed cost. Yes. Fixed cost plus variable cost equals the total cost, no, right? Average cost how we measure? That is delta, sorry, P divided by Q, no, right? Cost, total cost divided by output, no, right? So that is the average cost, no, right? Here, average cost, total cost is 146 divided by 1. So all the times now we take the divided by the 1 output level, right? So this is the average cost, right? First it's very high, then it's increased, come to the minimum level, right? Then after that it's increased, no, right? It's U-shaped, no, right? And the marginal cost, so that is the slope of the total cost function, delta C divided by delta Q, no, right? So if you take the difference, no, right? Divided by this difference, no, right? When you increase the output by 0 to 1, what is the change in total cost? No, right? This difference divided by this difference. Since this difference is always 1, right? So you can take this difference as marginal cost. No, right? Here this difference is 100, 146, 46, right? Starting from here, 46, right? Then 146 to 70, 32, right? That way, no, right? You can calculate the marginal cost. It's also initially high, no, right? And then it decrease, and then again come to the minimum level, right? Minimum level, right? And then increase, no, right? Average variable cost also, that means TVC divided by Q, right? So it's also initially high, increase, come to the minimum, then thereafter increase, no, right? So you see the U-shape curves, no, right? This curves, right? Now here the marginal cost, no, right? Initially high, right? And come to the minimum and then increase, right? We take the same way the total cost, also initially increase, stable, then improve. Let me increase at a faster rate, no, right? So that means now now this is the total cost, you know that, right? This is the somewhat stable, no, right? Point, right? So is the total cost increase, no, it output increase, right? Increase at a faster rate, right? So take this marginal cost, right? Come to the minimum, the marginal cost, right? So this is the economics of scale. This is the basic, right? The marginal cost increase. That one actually this range, right? If you take the marginal productivity, right? That's positive, right? Increasing, right? So if you compare with this the marginal productivity, right? It's actually increasing, not right? So this actually explains the economics of scale. There are these economics. Right? So because marginal cost decrease means marginal productivity increasing, right? Marginal productivity is positive, right? But increase cost, we know that with respect to the production function, right? You may remember we talked about the marginal productivity and the average productivity, right? The second stage, right? There the producer maximizes outputs, right? So at that point, the marginal productivity is positive. Marginal productivity, right? positive variable, right? So later on, marginal cost increase means marginal productivity negative there, not right? Right. So that means this economy is right. So normally producer decide the marginal productivity, right? Output level, right? Like at the region where the producer gain positive marginal productivity, right? Okay. Right. So that is something that we can see, right? So when you talk about this average marginal cost curves, right? We observe that it's come in shape, right? Right. Now here that is the case, right? Now you may remember we talk about the marginal productivity, average productivity, no, right? With respect to the total production function, no, right? So the total production increase continuously, and you remember, right? Total production increase, no, right? Up to the maximum level and then after decrease, right? So this is the marginal productivity increase, right? The actually average productivity also increase, right? So this is the area, right? The marginal productivity tends to decrease continuously, right? And the average productivity also decrease, right? Now, if you take these points, right? So when the marginal productivity is increasing, right? Marginal cost is the right here when initially it's come to the maximum point at this point, right? So they are actually marginal cost increase after the minimum. So then thereafter marginal productivity continuously decrease, right? That means marginal cost increase. We can see this inverse relationship with respect to and so the marginal productivity of labor, average productivity of labor, right? With respect to that, we can see the marginal cost and average cost, right? Inverse, right? Other way around, right? So, when the marginal productivity decrease, no, our marginal cost increase, no, right? And the average productivity comes to the maximum point, this point, no, right? Up to that point, my average variable cost decrease, no, right? So then the average productivity decrease, no, right? So then average variable cost also increase, no, right? So normally, you know that this is the area, somewhere here, no, producer maximize output, no, right? At this area, no, right? Where start. Where it start, where it start the decline in the average productivity, right? And that area, you know, that's continues to decrease the marginal productivity, you know, stage 2, right? Okay. So this is the area, no, right? So output maximize, no, right? According to that explanation, even in the production function, right? Now, if you see this one, right? Now the marginal cost we identified, no, right? So that is delta T may be divided by delta Q, no, right? Was marginal cost mainly explained by the variation of the total variable cost, right? With respect to changing the output, no, right? And if you rewrite this one, right? Delta TVC means what is delta TVC? Changing variable cost. So that means changing labor into the price we pay for the labor, no, right? Variable cost, no, right? How much we pay for the labor, right? So, let's explain the changing labor inputs, no, right? And the price you pay, wage rate. W is the wage rate into change in labor, right? So that is the change in total variable cost. Okay. So then we can write instead of delta TVC marginal cost means so W over delta L over delta Q, right? So this divided by delta Q, right? So that we can take the delta L over delta Q separately and the wage rate, right? So the product of lower delta Q into wage rate. That explains the marginal cost. Right? So that means now delta L over delta Q means it is the reciprocal of the marginal productivity of labor. No? Right? So marginal productivity of labor means delta Q over delta L. Right? Delta Q over delta L. Right? So we can rewrite this delta L over delta Q means 1 over NPL. Right? 1 over NPL means delta Q over delta L. Right? That in turn equals to delta L over delta Q. Right? So that means reciprocal of the marginal productivity, inverse. Marginal productivity into the wage rate, that is equals to the marginal cost, right? So there is something, no? This is the marginal productivity, this is marginal cost, right? And we take the variable cost, right? So average variable cost, right? That is related with the average productivity of labor, right? So how we explain the variable cost? Variable cost means we pay to the labor, no? Right? How much we take the labor inputs, no, into wage rate, no, right? Number of labor inputs into wage rate, no, right? That is the TVC, variable cost. TVC equal W into L. L means the number of labor inputs. Maybe the labor hours, number of labor workers, no, right? You incorporate 10 workers, per worker you pay 1,000 rupees, that is the variable cost, no, right? W into L, right? We can take the ABC, average variable cost means TVC divided by Q, right? And the TVC means W over L, WL divided by Q. So that we can write W into L over Q. L over Q means what? It is the reciprocal of the average productivity, no, right? 1 over average productivity. Because average productivity means Q over L, no, right? So this is the inverse. W into 1 over average productivity, no, right? So that is the average variable cost. Right? Yeah, heavy rain. Okay, right? So our variable cost is W into 1 over average productivity of labor. That is something inverse, no, related with the average variable cost, no, right? So average variable cost means inverse of the average productivity. So this is the average productivity of labor. So that's right. This is average variable cost, no, right? You can see. So this and this data relationship, no, right? Right. So this talk about the production function, right? And with respect to the production function, we need to change the output, right? Variation of the marginal productivity and average productivity, no, right? So that is related with the marginal cost and the rate variable cost. Okay. Is it clear? Okay. You can see right now, you know that cost depends on the output, no, right? So that is our starting point, no, right? So this is somewhat related to output, no, right? We talk about the production function. It relates with the cost, no, right? So the cost depends on the output, no, right? For the variable cost, marginal cost depends on the output, no, right? And that explain their productivities, no, average productivities and the marginal productivity, no, right? Okay, right. So any questions? Okay, right. So then you talk about like loan run drop cost curve, right? After the break, right? Okay. After the break, right? We'll go for questions, right? So, are you busy or working something? Our question regarding the how we conduct this normally the online that means MCQs and those tests. Then those who are in the so how they participate.
Uploaded in person on the elements for individual meetings. And they others will they are separate paper for everything.
For them separate. Can they monitor this? No, we cannot do no. The videos are online.
Yeah. First, is arranged the we take program each to identify their cameras.
Then how they submit to the LMS or direct send to the email.
Both.
I thought to give the MCQ, that's why I planned it that one. You go to link for their online, that's not. Majority are physical and online. Yeah, these days we have the assignments, exams, and so other in other courses, how about that? No exams, no MCQs for other courses. Assignments are there assigned?
Yes.
Presentation also there, no? That means within the lecture time, they take presentations. While doing the lectures, we take the presentations.
Exactly.
How many groups are there? How many groups are there? Six. Only there are actually those who are participating online, they make the presentation to LMS.
Yeah, they online one. They online one.
How many normally the participants? So they are predetermined, the groups are there already, the courses. No? How many participants are there now? How many group members? Combined five group members. The principal that is already finished, no, that course, perfect finished. What is the topic that you are referring to? Going to them. Demand supply equilibrium finished. Elasticities. And I think the consumer behavior is the last topic. No, that's not more topics to go. Is that the last topic? That means you are going to cover the overview of the macroeconomic solution. The principal form is how many continuous assessments given? MCQs. How many continuous assessments?
MCQ.
You have given the group assignment,
Yes.
individual.
No, only group. And percentage. MCQ is group assignment and group.
Or
She told that
MCQs there.
80 marks given for MCQ. Other side is from group assignment and group percentage. She told that their marks are fixed.
Yes, that's the problem. I also don't think that the individual assignment will become busy, right? Within the limited time, you have to. Since we have the plan to have this MCQ also, right? So you get ready for that also, right? Right. And doing the group assignment, right? The MCQ, this is also there are some questions, discussion type questions. You see the percentage of having the percentage. If you have the percentage, that's good, no, right? You don't have evening lectures. Weekdays, evening, no lectures. Colombo is having 2 days covering this over the course week is a problem. Attack hours.
Such time that first out really.
The 2 days will have full days. I think all these continuous service in 2 days over the course of reading, that's also important. Operating. If you must have 2 days in weekdays, evening also. If you are working, you can come in the evening. The students coming from remote areas. You don't have any interaction with your the students. Only few friends. Where are you? You are from? You are in Colombo. Both you are in Colombo.
Yeah.
Sister. When you sit for the relevance examinations. Last year,
No.
17. Why you thought to do that after 2011 now? Where are you working now?
What?
What? What something? What about there are a lot of students with the experience now in this. They answer the problem because earlier they had some scholarship programs. I mean, you know, now you don't have such because of this financial constraint. Down the expenses. You also work? Yeah.
Not 20%.
We need to the chartered, so we need to. You know, otherwise, first lessons.
Fine.
Fine.
Okay.
So we have done the economic, level common subject. You did 2017, so then first attempt then you decided not to repeat it. Then what is your results?
Units.
Only one attempt. How is this now? This program, this one is okay for you, or business economics? Patients can any doubts, things, or any cases. Is it there, the explanation? I'm happy with this. Contents and posts. It's very interesting now, since those things, some of these calculations, you can, both you are in the same place, you can do the group works. the Chinta is accountant.
About the V.
He's the accountant. No? He's the accountant. Join the end of it.
Oh.
With the course.
Control. Question.
Other, you're given the tutorials.
Some uploaded past paper, some are given in own game, that's the free, 20% take practice, practice for you.
Equipment of research and passport as then as in here. Maybe the paper is very different from the passport. Different, right? So that actually normally happen, right? So this is the first, right? And then. Let me see the, take some questions over here, actually it takes time. That's why I give you many questions. Apart from that, some questions, so I added that. So, okay. Very good.
Very much
I get to.
as we complete through the
6 months. Where you come from? Usually there is there. That because of right. Okay, so you can. Now this one shows that we talk about the relationship between the production partner and the fund channel, right? So basically, here we incorporate the average productivity, marginal productivity is not high. And the first function that we highlighted here, right? Marginal cost and the average cost, right? So then we come to the long run cost, right? Come to the long run cost, right? So, yeah, actually, we basically get the long run average cost, right? Long run average cost, right? So it actually, it's when you form the long run average cost, right? We basically look at the short run average cost also, right? Because essentially, the short run average cost means all the long run average cost. So, but here we know that in the long run, right? So the reference to scale principle applies, no, right? So with respect to change in the output level in the long run, right? Yeah, with the change in the variable factors, all the factors, no, positive and the negative, right? So therefore, in the long run production, right? So and even the long run average cost explain this returns to scale principle, right? That also a U-shape, right? So when you form the long run average cost curve, right? So that is called envelope curve, right? So envelope curve, right? So there also initially you see when the output is increasing the long run, right? Long run average cost also decrease, right? And that also minimize at a particular point, right? So that is an important point, right? Long run cost minimizing output level, right? and thereafter it tends to increase, right? So that also explain this returns to scale principle, right? So where we know that when the output increase in the long run, right? So average cost decrease, right? So that generates the increase in returns per scale, right? So when the output at higher level, right? So long run average cost also tends to increase, right? So that explains the returns per scale, right? So important point is the minimum point of the long run average cost, right? In that we know that especially in the perfectly competitive markets, right? The long run situations in the perfectly competitive markets, right? Produce at the minimum point of the average cost, right? Unlike other market settings, right? Imperfect market settings, right? So that is the minimum point of the long run average cost, right? So that generates the normal profits, right? So that's why it's very important, right? So normally we look at these cost minimizing output level, right? But when it comes to the imperfect markets, for an example, the monopoly market, right? Single firm operating in the industry, right? So they are actually producing not the minimum point of the average cost, right? Somewhat above, right? But the competitive market we see, so they are producing at the minimum point of the average cost, right? So the long run average cost is associated with the scale of the business, right? So if the scale of the business is increased, right? So that producer tries to increase the output level, right? Which generates the returns to scale, right? Which is changing the scale of the business, right? Now actually, when we go the long run average cost curve, right? So we take into account the short run average cost curve also, right? So that's also we observe that U shape, right? But we decide the optimum level of output, right? In the long run average cost curve, right? So what it explains the so many short run situations, right? Throughout the long run average cost curve, right? At the optimum level, right? So that is the minimum point, right? So we decide the optimum size of the business. That is the output level, which maximize the profits, right? The long run, right? So, right? Now here we take the long run average cost curve, this red line denotes the long run average cost curve, right? It's more called envelope curve, right? So like the shape of the short run average cost curve, we know that it's the U-shaped curve, right? But it's a more envelope, right? In the long run, right? So they actually denote the short run average cost curve, several short run average cost curve, right? But they are not going through the minimum point of the short run average cost curve, right? It is long run average cost curve, right? So it's tangent to the short run average cost curve, right? So what that's the minimum point. We see the common point, right? A particular short run average cost curve, that means cost minimizing output level. The minimum point of the long run average cost is same, right? So now the decreasing part, right, of the average cost curve explain the increasing returns to scale at the minimum point, right, of the long run average cost curve explain the constant returns to scale, right? So increasing average cost that explain the decreasing returns to scale. Now this point, this minimum point, right, of the long run average cost curve, right? So that is called the minimum efficient scale of the business, right? That is the cost minimizing output level in the long run. So we call it as minimum efficient scale, right? Q, right? Q is the minimum efficient point, right? So that is the long run cost minimizing output level. That is the minimum efficient scale. Right? That point is very important, right? So minimum efficient scale, right? Long run cost minimizing output level, right? Because now this is the particular point, long run cost minimizing output level, right? Okay. That will indicate now can use that one for assess the market situations, right? For an example, if this minimum efficient scale is less than the total market demand, right? So then it means the particular produce small firm, right? So they are producing insignificant amount of output for the market. So that indicate the market is a competitive market, right? This minimum efficiency scale is less than the total market demand. Right? So it is similar, closer to the market demand means there are few firms operating in the market, right? So that will explain the how many firms operate in the markets and the competitive level in the market, right? And the competition in the market, right, is on the minimum efficient scale, right? So we compare the minimum efficient scale output level with the market demand, right? So if it is less than, so it's a competitive market situation, right? Now, this is the minimum efficient scale, right? So normally it is the increasing return scale, right? That is generated economic scale, right? Here the constant, so here economic that means increasing return scale, right? So at this point there is the minimum point, right? That is scale, right? So now here NBS, that is the minimum efficient scale, right? It's the smallest output that the plant produce, right? In the long run average minimum, right? So this is the total cost, right? Total average cost, right? So at this point, right, at the minimum point, we see the increase in returns to scale decrease, right? So that means when the output level increase, right, it totally now economics of scale reduce, right? So when the level increase even in the long run, right? So it come to the when we start the constant returns at a particular level. And thereafter, even in the long run, right? If we increase the output level, right, average cost also decrease and generate decreasing returns to scale, right? That is the minimum efficient scale, right? So it can be useful to determine the market structures, right? The competition in the market, right? Comparing the market demand, right? If there are Q2 is very low, right? Q2 means minimum efficient scale, right? That means there are small firms operating in the market, right? Which is the market demand. There are a number of firms, right? So then when the number of firms increase in the market, right? That increases the competition in the market. That's it, right? There are very few firms operate, right? So that is called imperfect market, right? Imperfect market, right? Maybe the monopoly, one firm operate. If there are maybe the oligopoly, right? Two firms, right? Maybe the two firms operate, that is called duopoly, right? If there are more than, let's say, 20, 30 firms operate, somewhat competitive, monopolistic competitive market. So likewise, only one firm operate, pure monopoly market, right? Depending on the firms, right? Number of firms can assess the competition, right? And the nature of the market situation as well, right? Here that indicate now you do minimum efficient scale, right? So that output produce particular firm in the long run, right? So that is the size of the business in the long run, right? So how much the market share, right? The firms that particular firms operate, right? So that indicate the competition in the market, right? This firm is a very small firm, right? But if it's a large firm, right? So that means the market share also high, right? So that means there may be few firms operating in the market, right? That reflects the competitive level, right? So the minimum efficient scale we compare with the D means the demand, the market demand, right? So if it is less than the market demand, then it's a competitive market. Right? This minimum efficient scale equals to the market demand. What happened? It's a monopoly market. Right? Monopoly market. Right? The firm is monopoly. Right? So the only one firm operating the market. Right? So that's why this minimum efficient scale is important, right? So it gives us the total cost minimizing, average cost minimizing output. Right, now we have given the one question here, right? Can you quickly do it? Now we have given the long run LRTC means long run total cost. Okay. So we have given the long run total cost function, no, right? 2000 Q minus 5 Q square plus 0.005 Q power 3. What is the long run average cost? And the what? What is the firm's minimum efficient scale? So how you calculate the average cost? No, right? Average cost, long run average cost. We have given the long run total cost, no, right? Then the average cost is going in first, right? Right. So RCC divided by Q, no, right? We divide by the output level, no, right? So that gives the long run average cost, no, right? If you divide by the output, how much is the average cost? We have 2000 minus 5 Q plus 0.005 Q power 2, no, right? So that is the average cost. No? Okay. So then you can find the minimum efficient scale of the business. Minimum efficient scale of the business is the long run average cost. Cost minimizing, average cost minimizing output level. Right. That is the minimum efficient scale. We find the output level which minimize the long run average cost. No, right. Output level which minimize the long run average cost. Have given the long run average cost equal 3000 K minus 5 Q plus 0.005 50 power 2. The long run, how we find the long run for minimizing the output level? Average cost, right? So that means the LRAC, so you need to differentiate, no, right? Total average cost, because you need to find the minimum point cost minimizing, total cost minimizing, average cost. Right? Output level which minimize the total average cost. I think you might. Minus 5 Q. Yes, minus 5 Q. Because 5 Q is scared, you have given 5 Q, right? That is correct. Sir. 5 0.05 Q to power 2, no, right? By the output level. So this becomes minus 5 plus 0.10, right? 0.01. 0.01. Okay. Point 0.10, no? Right? Right, is it correct? Then this means at the minimum point, what happened? At the minimum, ELRC over DQ should be equals to 0 or something, right? Therefore, we can equate this function, right? Right? Then you can find the output level. How much? Output level, no? Was minimizing our output level. Average cost minimizing output level. We need to find the average cost envelope curve, right? Average cost, right? Point output level. So here we take the slope of the curve, right? Saturation, right? Then what is the output level? How much? 500. So giving the 100, right? Then we don't know whether now just we take the we equate to 0, no, right? Even though if I say that's the minimum point, it's wrong, right? But I at any point, whether it's maximum or minimum, now we know that slope equals to 0, no, right? In order to confirm this minimum point, we take the what we take. We take the second order derivative, right? You differentiate again this function you differentiate again, right? So that means D2 LRAC. Because we want to confirm that the minimum point. No? So that means we take the second order derivative. Second order derivative. First order derivative is not sufficient, no? Right? Second order derivative. To confirm is the minimum point, right? Because at any point, at maximum or minimum point, we know that slope is equals to 0, no? Right? So then we take the second order derivative, no? Right? Of this function, right? In order to confirm this is the minimum point. So once you get the second order derivative, how much? Becomes 0.01, right? That is positive. Positive, no? Positive means after that, second order derivative, after that it becomes positive, no? Right? It increases, no? Right? So that means this point is minimum. Star is minimum, no? Right? That's right, no? Right? So once you calculate the second order derivative, right? If it is the maximum point, no, after that it become negative, no, right? This is positive, no, right? This is negative, no. If it is negative second order, that means maximum. Now here, average cost means always we try to minimize, no, right? We try to find the minimum point, right? So that means it's negative, that means positive, right? So that means particular output level is the long run average cost minimizing output level, right? Okay. Right. Find output level, right? We have given some examples, right? You can do it, right? It is also right. So you can find the, you can just tell me what is the answer, right? Here, second one. How much is the total fixed cost? Now, total cost function is given, right? We know that total cost is total fixed cost plus total variable cost, right? Combining those two, we get the total cost. How much is the total fixed cost? It's 5,000, right? That is the part where I does not relate with our output, right? The total cost is, sorry, fixed cost is 5,000, variable cost is this part, right? 2,000 cube minus 10 cube square plus 0.25 cube power cube. That is the variable cost, right? So variable cost. Marginal cost means if you differentiate this function, no, right, you get the marginal cost. That means 2,000 minus 20 cube plus 0.75 cube to power cube, right? We differentiate this total cost function with the marginal cost. How much is the average variable cost? Minimizing output level. So you need to find the average. A variable cost is this one, no, right? 2,000 cube minus 10 cube square plus 0.3 power 3, no, right? Then you need to find the average variable cost divided by Q, right? Then you will take the differentiation of that, right? Average variable cost minimizing means you need to find the minimum point, right? Equate it to 0 and take the second order derivative of that, right? To confirm at the minimum point. So you can find the average cost minimizing output level, right? Okay. So you can do it, right? Okay. What's the increase? If it is increasing, positive. And it's increasing. At least mature by it's negative. Not the minus point is We now normally we take the first and the second into coming the activation we got no time. We see that we have to take the margin first margin first margin. So there the second condition is after that you have to give the maximum by the margin first will be this margin level. So this margin first will be the margin. Next issue should be there. Second. Likewise, if the conditions okay. The second we get the side of the second derivative. So, right now, then we can talk about the economics of scale, right? We know that we identified the two economies, right? Increasing and the decreasing, right? So here now in the long run we experience these economies of scale. This the scale of the business, right? Two economies, right? Internal economies we can identify, in other words, external economies, right? Right. As far as when we concern the organization, the firm, and the industry, right? With the expansion of the scale of the business, right? What are the benefits passed to the organization? Right? Those are the internal economies within the organization. Right? External economies mean outside, that means industry. Benefit passed to the industry, right? With the expansion of the industry, right? Likewise, we can identify the in broader terms, right? Two types of economies of scale, right? One is the internal, other one is the external, right? Simply the internal economic scales talk about the expansion of the firm, right? In the long run, scale of the business, as we discussed. It's rise with the expansion of the firm, right? So those are the benefits, right? Passed to the organization with the expansion of the business itself, right? The organization, so if we are going for a higher production, right, by increasing the scale of the business, right, with the change in the both factors of labor and the capital, the benefits pass to the organization. Those are the internal economics, right? Okay, it is also long run, right? So what are the economics? Internal economics. If we utilize the resources efficiently, right, the firm will be benefited. And the specialization, division of labor, right? We know that, right? We use this labor, right, in a productive way, right? The resources in most productive way, through the specialization and the division of labor, right? So that's benefit to the organization. Efficient transportation, right? Will benefit to the organization. Bulk purchasing, right? We can, other than taking the small quantities, we can take the bulk purchase, we'll get more discounts and so on, right? We can minimize the cost, right? With the organization, and the stock holding, we can manage the stocks, right? In proper manner, right? Using the stock holding techniques, maintain proper stock or something, right? Economic order quantity or something, right? You order the quantities, right? By looking at the economic order quantity, right? And we maintain some stocks, right? In order to face to the unexpected events, right? To continue the production process continuously, right? Without stopping, right? Right. Buffer stocks maintained, right? Some stock management techniques are there, right? If we use that one, organization. Right? And the financial managerial economic decisions, right? So within the organization, we take it, right? Good financial decisions, right? In order to continue the production, right? Utilize the resources, productively and manage the decisions. Strategic level, right? Strategic management decisions, right? Covering the whole organization and so on, right? So that will pass the benefit to the organization, right? So these things are, we can take it as an example of internal economic scales, right? So when it comes to the external economic scales, right? If you use labor force, right? Now we know that there are different categories of labor, right? Skilled, unskilled, semi-skilled, right? Use the labor force in the productivity, just, right? Skilled labor, right? So that will benefit to the whole industry, right? And if we have the professionals, like you in the future, right? Right? So whole industry will be benefited, right? Right. It's not confined to the particular organization, right? We have the skilled labor, country, right? Whole industry will be benefited. And ancillary services, ancillary industries, right? So like umbrella network, right? So the production firms has the network, right? Industry has some kind of network, right? So the separating the skilled labor supplied by the different organizations, materials supplied by different organizations, right? There are specialized institutions established, right, within the industry, to provide those subsidiary services, and marketing is handled by different organizations. Of the particular organization, there are established units, right? Organizations, right, within the industry, to provide such services to the organization in general, right? That is kind of umbrella network, right? Now, multinationals, transnational companies, we know that, right? That kind of network is there, right? That benefits whole industry, right? Right. So those are the external economies of scale, right? Later, and such kind of setup established the industry, right? Provide services, right? All the firms can be benefited, right? By acquiring those services, right? So those are the specialized institutions, they provide specialized service, specialization. Right? There's a benefit source, right? They ask to go whole industry. Right? So when you compare with this internal and external economics, right? We can say the external economics, compared with the external economics, internal economics scales are more important and significant, right? In the organization, right? So if the industry develop with the expansion of the business, right? With the expansion of the firms, right? Right. If the firms are efficient, industry also benefited, right? Industry further expand, right? The internal economies is more significant, right? Than the external, right? Right. So we take the minutes. It's a take, right? So cost elasticity, now we know that we talk about one thing, production elasticity, output elasticity, right? Earlier. Can you remember? We say the output elasticity or the production elasticity, same, right? Earlier we talk about, right? Output elasticity, respect to change in the output, which is output change with respect to change in the labor inputs, right? So likewise, we can talk about now the cost elasticity. What does it mean? Cost. So that is the change in cost due to change in the output. Okay. Here we take, because cost depends on the output, right? So cost is the dependent factor, independent variable is the output, right? Production. So then we can consider, we can measure and evaluate the responsiveness of cost due to change in the output. How much? Right. The percentage change in cost divided by percentage change in output. Percentage change in cost means the delta C over C, right? Delta C divided by C. Percentage change in output means delta Q divided by Q. Right? By rearranging that equation, you can find out delta C over delta Q into Q over T. Right? So that is the cost elasticity. Right? So if we take in the long run situation, this is the double C over double Q, right? Into Q over C. Double C over double Q, right? That is the slope of the cost function, right? With respect to change in the output, right? Double C over double Q into Q over C. Right? So once you calculate this cost elasticity, since it is long run, right? So long run, right? Because the cost is A, right? In the both factors, data and the capital, right? So that actually tells us about the returns to scale there also, right? So now the cost elasticity is less than 1, it says decreasing. If it is greater than 1, increasing. If it is equals to 1, constant returns to scale, right? So that's the change in the cost. Right? So then it is less than 1 means the cost change is not significant with the change in the output, right? So the cost change is not significant, right? The change in the output, right? So that is less than 1. By looking at this cost elasticity, we can identify the test efficiency, right? Okay, right. So that is the right now. Then we talk about the aspect also, right? First, right? Before there's right, right. Right now, this is the group assignment, right? Right now, I will give you the this will be available in the LMS, right? If you go to it, right? From this side, I think you know the group, right? Of the students, I don't know, right? I will upload that one to the LMS, right? Now, you are members, right? Comprising 5 members each group, right? Taking the list, right? Already, right? From first to maybe 36 students are there, right? So this is the group assignment, right? So talk about this initial things, right? Business economics, right? So how do you use that one, right? We need to discuss the importance and the relevance of this economics, right? The current situation, how you can use that one, right? To explain the problems faced by the business, right? How it is facilitated, right? Basically, we talk about the scope of the business economy, right? One side is the area and sometimes and functional areas and the methodology, economic methodology, right? Is that how you can use the business economics? Or to explain the problem faced by the organization, right? Under this economic crisis, financial crisis, because we know that financial crisis affect the organization, right? Different way, right? Like especially we know that small medium industries, right? There are so many stories, right? May heard, right? Regarding the small medium industry, right? There are so many problems we find there, right? So how is the basically business economics, which we talk about microeconomics, macroeconomics, we use the right? It's not that. How it is applied, right? To identify those problems, right? And to solve those problems, right? To get business, right? Okay. That is the question, right? So the deadline is 22nd. Okay. Then I will give it. Is it okay? So that is the, because now I think the November 4th is the last day, no, right? According to the given time schedule, right? Right? And November, right? Finish. So, right. 22nd, now we have the 3 weeks, right? To do this, okay? So, you have given some ideas, right? So, how to organize your structure as well, right? You need to identify the production part, right? And something the current crisis situation, right? So economic crisis, right? And the impact of the business, you can talk about something, right? Take it into the literature, right? So, and sometimes we may read the different articles, talk about this, right? And business economics main areas, focus areas, scope of business economics, and the subject area, right? You can talk about, right? And what kind of how you can link, right? Business economics to explain the problem, right? Yes, the business organization, right? Sometimes their knowledge about economics, something, right? Discussions and then finally you need to make your conclusions, right? And you will take good your references, right? Some books, magazines. Right. So don't copy from the internet, right? Subject page, right? So you need to write in your own words, right? You can refer to material, right? You need to write your own words. Your justifications, something like your own interpretations, right? So elaborate the knowledge on that area, right? Now, I said 15 marks, okay, right? So anyway, right now we need to critically analyze the situations, not right? If there are arguments, both sides, favorable, unfavorable, you can, right? And you can take new way, right? To analyze the situations, problems faced, right? Based on the support of the teacher that you right. Likewise, develop your own arguments and conclusions, right? Based on some. Okay, guys. So that is the side, right? That will be a group assignment, right? So there will be a presentation also, right? Right. It will take extra time to make the presentation, right? I will try to hear your voice also, right? So, at the last moment, right? Right. Okay, so problem is I think if you have any group list, you can send me. Do you have a group list? Do you have? Do you have previous ones you have? Same, at least we can apply, then you can send it to scan. Right.
Can we do this assignment based on the fuel? Can we any chance to do this assignment based on the fuel?
Few,
Yes.
few members.
No, fuel.
You can't hear.
Fuels.
Few. So, what is it? I think we will work.
Based on the crude oil fluctuation.
Good. You are. That is what, right, this also that is when the explaining the things you can take into account. I thought that. But the root over that's also a factor, or I when we explain the problem, the starting point of the problem, even in the government policies and so on, right? So many things are there, no, right? Crisis situation, how it is created, right? You can form your argument and also factors you can discuss. World oil price high, or increase high.
Yes.
Yeah, that's also the can. So here you may think about different ways. You may have different groups, may have different approaches, right? You can develop your own arguments and what. Right? So true or no, right? In practically, you need to justify your argument. That's it, right? If it is realistic, if it is justifiable with your facts and figures, right? That's okay. Right? Your own arguments, right? And it should be justified, right? Okay. And you are clever, right? Based on the evidence for something or right? Based on your own argument, right? And so you can identify different factors as you mentioned, world prices, no, right? So, price hike, right? So that also goes, right? We talk about business, no, right? So the transport cost and so on, right? Some SMBs, if you take, no, right? The significant impact of that, no, right? Can discuss all in the discussion. There may be different approach. You may think about it different ways, no, right? In your group, you can discuss, right? Group leader can organize the discussions, right? Carry out your discussions, right? And come up with your arguments, right? So as conclusion, right? Okay. Right. So that is the group button. I gave you the discussion question also, right? So those who participate lately, right? You can take it, right? I will upload that one to the lessons today, right? There will be need to be something tomorrow, right? Yes, I don't know that. That's right. I will do that. I will certainly see that one also. I only gave the side stuff, right? So the link to upload is not here. We'll do that. Okay, then, thank you very much. We'll meet next time.